meantime, I hope you all have something to keep yourself lubricated with. And I'm going to turn you over to Oleg, who's going to introduce Ruben and tonight's event and set some of the ground rules for you.
Sure. Thank you. Thanks, Larry. So welcome all from me as well. I mean,
change your name on Zoom.
Well familiar with Crypto Mondays. It's great to see so many familiar faces as well. Just one quick word on the structure of the event. So Ruben will be hosting the workshop. He will be presenting and covering a few topics. If you have any questions during the talk, write them in the chat, and I will either ask Ruben to go through them at the end of the presentation, or if I feel that it's a really just short, timely question on something immediate he's saying, I will ask him to comment on it straight away, if that's okay. And then just as a quick introduction, Ruben Cisternino, he's our head of trading at Coinrule, which is the company I'm a co-founder of. So it's a great opportunity and great honor for us to actually have him here. He's a very, very experienced trader who has been working in the financial markets for over 7 years. He worked previously in the traditional finance world, in asset management and retail brokerage at companies like GAM and FinecoBank. And since about, when was it, Ruben, 2017, he's gone all in on crypto, and he's not been stopped by anything what the market would throw at him. And he's in charge of really not just educating our users and providing strategies and trying out different approaches to the market, but also actually from managing Coinrule's treasury all the way down to helping the users to successfully use our trading platform. It's all in his hands. So it's a great honor to have him. And Ruben, I'm passing the word on to you.
Thanks, Oleg, for the very kind words. Hi, everyone. Thanks for having me today. So yes, basically, I started my career in the financial markets. I was dealing with a lot of different financial instruments, stocks, bonds, derivatives, and whatsoever. And at the very beginning of my career, I thought that financial markets were amazing because every day there was something new going on, and that new event, new news coming to the market were bringing a lot of opportunities for people to make money. Then after around 7 years that I've been working there, I found out that basically everything that seemed like to be new at the beginning was not actually that new every day. So even there was some kind of routine going on. 2017, I was in a big trading event. I got in touch with a friend of mine that was involved for many years before with cryptocurrencies. We started to chat. I still remember the first night we were in front of his screen, and for the first time Ethereum crossed $100, and he was cheering up so much. He was saying, "Oh man, it's amazing, it's incredible, the market is going up so much." And that was just the beginning, actually. So I still recall back then how $100 for Ethereum was something incredible. And nowadays we are at 500, and still there are people that can be still skeptical about cryptocurrencies. So it's a really, I think, magical world that can provide a lot of opportunities. May I share my screen? Because I prepared some slides. Can you all see my screen?
Yeah, we can.
Perfect. So I would like to start from something that I think it really makes sense at this point, because everyone that is approaching trading, but especially crypto trading, this is how they see themselves. So in a joyful company, just buying and selling coins and making money every day. But in the end of the day, this is how reality is for most of the people. Statistics Now, jokes apart, statistics say that around 70% of people that trade, and these are statistics that come from retail stock brokerage firm, are in loss. So that means that even if there are so many opportunities in the market, in the end of the day, most of the people are not able to manage the market. Why is that? There are main reasons for that. The first and probably the most important is that trading is very stressful. So it seems like it's just about buying low and sell high a coin, but there is just a very small part of the story. There are two main things that people need to deal with, which are losses, which can be the most straightforward thing to think about it. So you have put your money on the market, your money at risk, and when you see the loss, you are scared to manage your funds. So there comes the decision: should I sell? Should I hold? Is it going lower? Is it going to rebound? What to do at this point? But this is the thing that everyone considers. On the other side, there is also the problem of when to sell, that sometimes can be even more stressful. So after managing the loss, the coin is at break even, starts to go up again, but is it now the time to sell? Should it go higher? What to do next? So loss and profit are very strong component that drive stress into our mind. And as we know, when we are stressed, our decision process becomes to be at risk. So all the decisions that we thought were very straightforward, very clear when we bought the coin, now all our certainties seem to be falling apart. So all these components have a very strong impact on our decision-making process. On top of this, markets are not always rational. Financial theory says that market should be rational. All market participants should make their decision based on rational assessment, but that in the end of the day, it's not really reality. One of the biggest example of this is probably the best movie that anyone could see about trading, which is The Big Short. The story of the movie, for those that didn't watch it, is basically the story of this trader that ran through the numbers of all the mortgage-backed securities in 28 before the burst of the big financial crisis, and he was totally certain that something was wrong. Those assets were absolutely overvalued, and so he started to pile up on short position. A short position is when someone is taking is starting an investment that will pay off if the price of the asset is going down. Now, according to financial theory, he was taking a rational decision. In the end of the day, he was probably lucky to be able to remain liquid and solvent in his fund before the bubble burst. Because if he wouldn't be able to manage the losses that lasted for many, many months, probably we wouldn't have had him as the hero of the traders of that time. On top of this, variables also in play on the market are so many that it's very difficult to have only one view on the market. So this is something that I also came across when I was working in a bank. We were literally flooded by analysis from all other analysts, other investment banks, and every day, literally, there was an analyst that was saying this stock is overvalued, and then the very same stock was labeled as undervalued by another analyst, because the other analyst was taking into account other variables for his assessment. So that means that it's very difficult to just have a overall complete overview of everything that is going on, just simply because there are too many things that our mind should be prepared to analyze. And yet, even if you are able to analyze as many variables as possible, to read as many news as possible, still there is something that can happen that you didn't take into account before, and maybe not just you didn't take into account, but all the market didn't take into account. A very great example of this was the pandemic that hit the market mostly as its main effect in March 2020. Nobody was expecting that 2020 would have unfolded with a series of global lockdown, global the disruption of businesses and whatsoever. So these are things that no matter how careful you analyze the market, you should always expect the unexpected. Then I would like to point out another variable which sometimes it's not considered as it should be, is that unfortunately in the room, in the trading room, there is always a smarter than you. So in the trading environment, there are involved the most bright minds in the world. There are physicians, there are traders, and all kind of people that have a lot of financial skills to tackle the market. And for this reason, no matter how prepared you think you are, still you should take into account that if someone is buying or someone is selling, probably has more information than you to do that, to take that action. Let's go a bit more into our topic. So when everyone is looking at Bitcoin, more or less, this is what they have in their mind. So an exponential rise in price since basically the beginning, since its inception. And probably we have heard many times the hypothetical scenario in which, oh, if I would have bought Bitcoin in 2012, I could have put only just a few $100 and now I would be millionaire. Actually, this is true in theory, but in practice, to be able to reach that status of millionaire nowadays, you should have first invested in Bitcoin at the time. So first, you should have been informed on this kind of new technology. And second, you should have handled the incredible volatility that the price experienced along the years. We can see that, for example, from 2012, since okay, now this is better. From 2012 to 2014, the price increased something like 49,000%, only to fall around 87% in a time span of around 1 year. And bear in mind, when you buy something at, let's say here it was $4, $10, maybe you bought Bitcoin around this price, and you hold the coin until 150, 200, $300, only to see the price to fall apart until a level of around $50 to $60. That involves, and consider what I was saying before, that stressful component that each trader experiences every day, a very, very strong pressure to sell and to realize those profits that he was seeing in his wallet. So again, maybe he survived the first drop because he was still a believer. But then again, the price rose around 12,000% since the lows in 2015 to reach the new all-time high around 20,000, 19 something around 2018. Again, at that point, the price falls. Ironically, the magnitude in percentage terms is very similar to the drop that the price experienced between 2014 and 2015, also in a comparable amount of time. Now, today I was preparing this chart, and I was remembering that actually in 2018 I was with Oleg in London. It was the very early stages of our company. We were discussing how to structure the business model and everything and the product. And I ran a very small trading workshop about how to trade. And if Oleg recalls the time, I said maybe we are very close to the bottom. And it was actually December 2018 when actually the bottom was there. The price consolidated a bit before the big spike. If not wrong, it was like something 20% in just one day on April the 2nd of 2019. That was originally probably the time in which the price was going out from the big bull market. Then we see that there is this red candle on the downside, which marks the market crash caused by the pandemic in March 2020, just to see the trend picking up again. So what are the takes here to take into account? First, that if you want to gain something on the market, you need also to be prepared to handle some losses. There is no way that you can enter, you buy something, and you will only see your position in profit. So that brings up to the first point. The only way that people could have managed to survive all this roller coaster of price increases and decreases over the year was managing the size of their investment. So this brings us to probably the main golden rule of trading, which is never invest more than you can afford to lose. Because considering all the things that we said before, that the market is irrational, there is always something unexpected that can happen on the market and whatsoever. No matter how prepared you think you are to handle the market, still something can go wrong. And at that point, you cannot afford to lose all your capital, because the only way to be able to stay on the market as long as possible, to be able to profit, is to be liquid and solvent with your capital. So there is also something that sometimes I read, if you cannot handle a 20-30% price drop in the cryptocurrencies, then you don't deserve the 100, 200, 300% price increase that usually follows after. And this is also something that is a very hot topic among traders. I often talk with people that never traded cryptocurrencies, but they've been trading stocks and futures or forex for decades. And many times they say, no, but I will never be able to trade cryptocurrencies because they are too volatile. But this is a false myth, because the only way to manage the volatility and so the risk of an investment is to manage the size of your position. There was, for example, a news that hit the market a few days ago, which was that Mass Mutual, the a very old historical insurance company, announced that they are going to allocate 100 million worth of Bitcoin for their portfolio. Of course, all people that are, let's say, used to see insurance companies as investment companies that only allocate their capital into very safe assets, they thought that this was something crazy. But actually, I ran into some quick calculation, and I came up to these numbers. So an investment of $100 million for an insurance company that holds something like 500 billion worth of asset is less than 0.02%, which means that if they are wrong in their investment, and in the hypothetical scenario that Bitcoin will go to zero, basically they are risking only 0.02% of their asset allocation. On the other hand, imagine that 20K is just again a very strong resistance, as we see here, and the price after breaking this resistance skyrocket on the upside. If it reaches 200K in price Bitcoin, the total profit, we're talking about profit, not the overall position, but just the profit that Mass Mutual would earn would be around 1 billion. Since usually an insurance company invests in very safe assets, the safest asset that we can think about nowadays is the Fed funds. So basically, you are investing at the return rate on the US dollar. That return is something like 0.25%. To earn that much, Mass Mutual should invest something like $40 billion, which is 7% of their asset allocation, for 10 years. So now we are clearly seeing how valuable is investing in cryptocurrencies, and not just going all in into cryptocurrencies, but just investing a small portion of your capital, a portion that nowadays doesn't basically cost you nothing. Basically, you can totally be able to lose that amount invested, but in 5 to 10 years, maybe that amount would be much more relevant for your finances than it is now. There is no other investment asset class that can give you this return on the market. Now, this is so far we have been talking about only buying an asset and holding it along the time. still we introduced a very important concept, which is the risk management, which is the basis for any profitable long-term trading strategies. Now we will add also some technical analysis notions. So basically, what a trader usually do, looks at the chart because he's looking at some patterns that are recurring along the time. And usually, since many other players on the market are looking at those signals, when that specific signal or price pattern applies, turns we can say the analysis, turns up the analysis of each trader and gives a buy signal to jump into the market. More traders jumps into the market, there is more buying pressure. Less traders are selling because they see that the price is rising strongly, and so there is this imbalance between buyers and sellers, and ultimately this is the strongest force in the market, supply and demand, that since is directly reflected into how the price moves every day. That's why it becomes relevant to observe how the price moves every day. So here I made some example just to see how a very simple trading strategy can add the value. So imagine that you would have invested $100 in Bitcoin in 2012. Basically, nowadays you would have around $870,000. So this is the scenario we were talking before. So you just buy, you are able to manage with your psychology all the ups and downs of the price along the time, and then you are able to achieve this amazing profit. But if we add the most basic and simple technical indicator, which is a moving average. What is a moving average? Each point of this blue line represents an average of the previous closing price here in the chart. This is a weekly chart, so which means that each of these bars represent how the price moved during 1 week. So here we have a 50 period moving average plotted on the chart. That means that each point of the moving average represents the average price in about 1 year. So it's a very long smoothing of the short-term price volatility, and that gives a very significant simplification of how the trend moves. Usually a sell signal comes when the price crosses below a moving average. Why this? Because mathematically, if the more the price is divergent from the moving average, the more it means that the price is going up, let's say, more than the average, like the indicator would suggest. In a mean reversal strategy, that means that the price sooner or later should fall back. That exact moment that is used by the trader is when the price crosses below the moving average. This is, as I said, a very simple trading strategy. You can apply that with free tools, and using this strategy, you would have got one sell signal here, one buy signal at the end of 2015, sell signal in 2018, buy signal in 2019. 2020, we would have had some and that's why I think that COVID in 2020 was absolutely an unexpected event. Probably the price would have rose earlier, near to a new all-time high, if the pandemic would have hit the market in March.
Ruben, one quick question we're getting. Can you please explain the buy and sell signals?
Yeah, sure. So basically, the sell signal comes when the price crosses below the moving average. This is an indication that the trend is weakening. So the price is not that higher anymore compared to the historical average price. And usually that is an indication that the price is actually turning on the downside. And this is actually what happened here. Then the moving average, since it takes into account how the price moves in the previous weeks, of course, adjust itself. And also the moving average start to trend on lower. Lower is the moving average, lower is the price. But when the price again becomes closer to the moving average, it means that the trend is gaining strength again. And when it crosses above the moving average, that is usually considered as a buy signal. So we have sell signal when the price crosses below, buy signal when the price crosses above the moving average. Using this strategy, as I was saying, we could have imagined to buy again $100 in 2012, sell here where we have the sell signal in 2014. We would have cash out with a profit of around $26,000. Then again, we wait for the next buy signal that comes in late 2015. 2015, we buy again with all our capital, and the next sell signal comes here in 2018. The new profit would be around $740,000 for an overall position amount of $660,000. Again, new sell buy signal in 2019. That would have returned an overall value of our wallet today of $2.7 million compared to 870 of a simple buy and hold strategy. That means that with just 1, 2, 3, 4 trades across basically 7 years, the return would have been tripled, more than triple, than just buying and hold the asset. Now, we started from a buy and hold strategy to a very long-term strategy, but then we can go always deeper and deeper and deeper with more technical and more advanced, more low time frame strategies, maybe based on how the price moves in 30 minutes, 40 minutes, 1 hour, 4 hours, and so on, so that we can take even more advantage of each price swing at any point. But let's go back to our main point, which is the importance of a stop loss, because not only a trader can look at indicators such as the moving average to take his investment decision, but we can also identify levels at which the price becomes very sensitive. When this price level is breached, usually this leads to very, very strong price movement in the direction of the price breakout. This is exactly what happened in 2018 when the price was hovering this resistance around $6,000. When finally the price breaches below this level, this leads to a price drop of around 30–35% in just a matter of days, only to find a new support here, where was the strongest consolidation before the big price spike in late 2018. So not only it's important to use technical indicators, but it's also, if not even more important, especially for beginner traders, to look at where the price stops and stalls also for a long time, because when that level is broken, usually it means that there are strong price movement that are coming. Now we can see this as on the downside, but we can see the same thing also on the upside. This can be connected a bit to what we were saying before about Bitcoin. So when all-time high is broken, then there is no more price reference on the upside for sellers that can use that price reference as a good selling point. And that's why sellers don't know anymore when to sell and at which point to sell. Buyers only see price going up, so they are willing to buy at even less convenient prices. And that's the perfect formula for the price to increase that much. Remember always what we said about the balance between supply and demand. And this is especially true for cryptocurrencies, where most of them have a fixed supply of coin. So that means that if nobody is willing to sell that coin and there are more and more people instead willing to buy, that becomes the propeller for an exponential price increase. Now, let's just briefly go back here, because I would like to point out also a very crucial thing, which is we said that the price could drop around 30%. If you are not for your investment size, you think that a price drop of 30% would be would cause too much damage, then what is the solution? As we said before, just decrease the size of your investment, reduce the exposure that you have to the market, so that you can handle also that potential loss more and more easily. Just quickly some remarks, because this can be a bit overwhelming. I totally understand. So that's also something that we do every day. We try to make here with our company, we try to make the trading activities for newbies more easy as possible, and especially crypto market are very, very complex market to trade in, because trades 24 hours every day, so it's very difficult to follow the price so closely at any time. There are so many variables that you should look at the market, and that's why an automated strategies that take into account so many different inputs every day can be very useful. Also, another thing that I didn't stress enough, but it's probably the second main pillar of trading, is that you should have a plan and you should stick with it. Because as we said at the very beginning, when stress comes into your investment decision, into your investment process, then you are not taking decisions clearly anymore. And that's where the biggest, you will likely make the biggest mistakes. No feelings involved. So that means that you should take apart from your investment decision each kind of feeling that you may have, which can be the stress, euphoria, despair, and whatsoever. You should always stick to the plan and apply your strategy in the more clear way as possible. And also, just like we did looking at the charts, saying this pattern worked so well in the past, so that when you spot a pattern that worked well in the past, that gives you the possibility to make some forecast also for the future and say, this is how it worked. How can I take advantage of that setup in the future? Always considering what could go wrong, and you manage that uncertain variable, what can go wrong, using risk management approach, such as reducing the size of your investment. Main takeaways, so is never risk too much that you can afford to lose. Always have a plan, so always be prepared to put in place the strategy that you started with, and don't try to change over time that too often, because that can lead to mistakes on top of your mistake, and you are never able to assess properly your trading strategy or your initial plan. So also being able to admit a mistake, this is probably the toughest among all the tasks that each trader should deal with every day. Every trader, look back at the initial slide where there was Leonardo DiCaprio in Wolf of Wall Street. They think that they are some kind of gods, that they always know what to do. And this leads to a mindset in which you never tend to admit your mistakes. But admitting mistakes can really save you money sometimes. The perfect trading strategy doesn't exist, so you always need to find the perfect trading strategy that works better for you and that can adapt better to your needs. And most importantly, and finally, trading is not betting. So I try to give you some key things to take into account when you trade. And I think that all these elements are very far from what you consider betting. So just put money in something because you expect things to take profit in the future. So finally, trade safely, and thank you.
Thank you, Ruben. Now would be the moment when everyone claps, but of course, that's more difficult on Zoom. Thank you so much. That was very interesting. We've got already the first question from Yanif, which is, what are the cons of using the moving average buy-sell signals? Since this is a common technique, how come not everybody is using it?
Well, actually, most of the people use moving averages. The thing is that we were looking at moving average 50 on a 1 week period. That means that that moving average would have returned only 4 signals across 10 years. So we just made a very long-term strategy. We showed a very long-term strategy. And for many people, for many traders, that is not enough. So this is something that I talk with beginner traders every day, and they think that trading more leads into more profits, which is probably very far from reality. So most of the time, it's much better to take less trades but that can lead to a more confident risk reward than other more frequent trades that can lead to more losses. So there are so many different setups, there are so many different time frames, and there are so many different indicators, because the moving average is the most simple. But next to moving average, there are so many other indicators that other traders look at. And that's why in the very short term, that leads to a very, very strong volatility. So that's the main reason why not everyone is looking at that indicator. Different objectives, different time frame, and people looking at different indicators on the market.
Thank you, Ruben. Do we have any more questions at the moment? Otherwise, I've got a question. Actually, so question from me. They obviously well, two questions actually. The first one is there are quite a few people who don't seem to believe in technical analysis. Like they think that's some kind of dark magic, etc. What would you say to them?
I think that the main reason everyone looks at technical analysis is because, as I mentioned already, there are so many things that can have an impact on the course of the price that it's so difficult to keep track of all these variables. Nevertheless, all these variables translates into a shift, ongoing shift between supply and demand. So good news hits the market, people wants to buy, less people wants to sell, the price goes up. So in the end of the day, the chart is the most simple, if not synthetic, indicator of the status of a market. And that's why it is so valuable, because no matter, you can also not read all the news that comes out every day about Bitcoin, and still you can look at the chart and you can say, okay, there is something good now. We are back to close to new all-time high. So you can give a very synthetic judgment just looking at the chart.
Thank you. And we have started to get a lot of questions come in, so people are not shy anymore. That's great. We have one question from Lisa. Where or how do you gather information? What are your favorite sources?
So my favorite source, and that's since my past experience with financial markets, it's Twitter. There is so much valuable content that you would find every day on your timeline on Twitter. But of course, it's difficult to filter out all the noise and all people that claim to be traders, that claim to be expert about a specific topic. So if you go on Twitter and you start to filter out slowly the content that you can get, and you can start to analyze in a critical way also what you are getting. So you are not, I like Twitter because it's something that challenges you to be active rather than a platform like Facebook, Instagram, or other social media, because they tend to keep you more passive. They just propose your content without any push to know more. Instead, I think that Twitter is something very challenging and that can enrich a lot people, especially with trading.
Mm-hmm. And just to add to Ruben's answer, actually, Ruben wrote an article on the top 10 traders to follow on Twitter. I've just shared the link here on in the chat if you're interested. Then we had one common question from Andy. Andy says, great presentation, thank you. Is the moving average buy-sell signals you presented generally true across crypto or just for Bitcoin?
it's generally true across any asset class. So this is generally true for any traded asset in the world. So the more you go into the most used moving average, which is usually the 50, 100, 200, or 9 if you're looking at specific time period. So I'm very big fan of those classic common setup for moving average, because that means that more people will be looking at that indicator. If more people will be looking at that indicator, they will get the same buy signal that you just got. That ignite a self-propelling prophecy that brings automatically the price up.
Thank you, Ruben. And then we have a question here from Candy. Do you believe a nice balance between hodling and taking profits will likely lead to higher success?
Yes, absolutely. I myself, I am hodling a lot of coins. I remember still the first time that I talked with Oleg that I mentioned waves. If you remember, it was back 2018, and since then I never moved my waves from my wallet on the blockchain. I just accumulated more across the time, and now I am well in profit after a few years. But that is just part of my portfolio. I like to manage in more active way other part of my portfolio. So yes, balancing hodling and trading, I think it's a very good approach.
And then we have a question from Chaitanya. What is your advice to someone who has never traded in Bitcoin but has experience in trading in stocks? What is the best way to get started, and how much investments does one need?
So the people that are already accustomed with trading stocks, they have a very good advantage because they already know what it means to manage losses and manage profits. So starting from that point of view, they have a very big advantage on completely newbies for in the trading field. That said, you need to adjust your investment size compared to the volatility of Bitcoin. So if you're used to have to trade stocks that in a day that they can drop a lot, they will drop 10%, you need to be prepared that Bitcoin could potentially drop 15%, 20% in a couple of days, as we saw in March. So the best advice would be just invest a fraction, 50% of what you are used to investing in stocks. And then when the more you gain confidence with the asset that you are trading, in case you can increase your exposure.
Thank you, Ruben. There's one more question. Candy, can you please advise if newbies, well, this is a very specific question. Can you please advise if newbies can trade on Bybit?
No. my simple question is no, because Bybit is a platform that involves leverage trading. So leverage trading is something that people should start doing, start experiencing only if, see my previous consideration, they know what it means to handle and to manage losses and profit on their wallet. When you have that feeling of understanding what is the maximum level in which you can push your wallet in terms of losses, then you can start considering adding leverage to your portfolio. The first step that I always try to suggest to people is when they start approaching leverage is the following. So imagine that you are always used to buy and sell $300, $200 of a certain crypto coin. when you start trading with leverage, keep the same amount that you are used to trade with your spot wallet. In this way, you are first understanding how it works with stop losses, automatic stop losses imposed by the exchange, liquidation, and whatsoever. Then at that point, you can gradually increase your leverage. But if you are used to trade $200 and then you start trading on Bybit, putting as a collateral $200 with a leverage of 50, you are basically trading 50 times more than $200, likely you will lose everything in a matter of days.
Thank you, Ruben. No questions right now. So one quick question from me. What would you recommend to people who actually want to get more into trading? So they listen to you now. Where should they go? What should they read? What's a good place for them to learn?
So as I said, there are, you mentioned, for example, my article. There are a couple of traders that I mentioned that they post on a regular basis tutorials, how to trade, trading setup that makes you understand the mindset of a successful trader. First. Second, since we are talking about cryptocurrencies, I think that there is probably the best place where you can start understanding more about trading, which is Binance Academy. Binance has this very huge section on their website where you can find basically all the most relevant trading words, trading strategies, and everything that you would need at the very beginning for approaching the trading of cryptocurrencies.
And just because Ruben is a very humble man, but he also writes a lot in Coinrule's knowledge base. So I'm going to share the link to that as well, because I think there's some really good articles on how to get started. Any more questions? Anyone? Any comments, thoughts, questions while we still have Ruben with us? I think Caitlin. No, your camera went on. I think everyone is looking at the.
Everyone is going on Binance Academy too.
Yeah, there's a question from Candy. Do you specialize in other crypto or mainly Bitcoin?
I'm not a maximalist, absolutely. Honestly, I trade mostly altcoins rather than Bitcoins. So I tend to see my previous note. I tend to hold Bitcoin and then trade altcoins versus Bitcoin in order to accumulate long-term more Bitcoin. Because in the end of the day, when you are buying an altcoin, apart from Ethereum, I don't see any use case nowadays for people to hold or to use to spend any other cryptocurrencies. So in this period, still using altcoins is mostly a way, trading altcoins is mostly a way to accumulate more dollar or more Bitcoin as you want. And since the volatility is higher than Bitcoin, I find them more interesting.
We have actually a few more questions that just came up. Two questions from two sides of the extreme. You will see in a second. So the first one is, how can newbies find outs that have yet to pump?
Sorry, I did.
How can newbies find outs that have yet to pump?
Well, that is the $1 million question, I would say. But actually, there are some pattern, and again, looking on Twitter, there is plenty of trading setup that you would find, and in some cases, you will find, for example, look back at my presentation where I was showing a chart where the price is pushing on a resistance before the breakout. So when you see this prolonged accumulation, consolidations below a very key resistance, then at that point, the risk reward of buying can be very good, and you could find yourself in a very good position. Also, I would like to mention that apart from the specific setup, one thing that we have been noticing across the last 6 months is that Bitcoin has a very strong price movement, then goes sideways for weeks or possibly for a couple of months. At that time, it's more likely that you will see altcoin pumping strongly. So in periods of low volatility of Bitcoin, a coin that is consolidating below a key resistance, these are good ingredients for a good pump.
Mm-hmm. And then a question from a more, from a different angle. Sometimes crypto markets seem quite irrational amid accusations of manipulation by whales, etc. How can you trade such a market given these risks?
With conscious stop losses, trading the amount that fits your risk aversion. So as I said, manipulation happens at any level, even on stocks, on bonds. It depends what you call manipulation. You could also call manipulation the central bank of Switzerland that was saying for years we will defend a certain peg to the dollar, and then all of a sudden they say, guys, you know what? The peg is gone, and then the Swiss franc crashed 30% in a matter of just a few hours. So this is a general component that at different level, on different scales, happen on any traded asset. So how you manage it just with a stop loss and managing your allocation.
I remember being at Citibank when the central bank cut that peg, and we lost a few $100 million in a very, very, very short span of time.
Everyone that was working in the financial market will remember that as the 9/11 for common people. It's everyone remembers exactly where they were during that day. It was like 12th of January, something like this.
Fun days. We have a question from Lionel. Is it worth diversifying in different coins, or are they all correlated?
There is a very strong correlation for sure. And Oleg said that I am humble, but actually I wrote an article about correlations. And yes, this is something that you should really take into account. There is a very valuable tool, which is Crypto Watch from Kraken. They offer this very big matrix of correlation between all assets, between all coins. And yes, in periods in which you want to reduce the risk of your portfolio, it's totally not a savvy choice to add more coins that are strongly correlated. So even if diversification implies that you should add more coin in order to diversify, but that diversification effect only comes into effect if you are adding coin that are decorrelated one to each other. If you are adding Litecoin, Ethereum, XRP, and I don't know, Bitcoin in your wallet, of course you will be mostly going up when the market is going up and going down when the market is going down. Instead, there are coins that may be in the middle of the market capitalization of cryptocurrencies that could be interesting. Again, there are a lot of free tools that you can look at on the market where you can spot the correlated asset. You look at that asset. If you think that it's a solid project, then you can go through your usual due diligence in buying the coin, but that could be a very valuable addition to your wallet.
And then we have a question from Lewis. He says, another newbie question, Ruben, why even trade? Your $100 example of 4 trades. Surely if you just invest, it will have great returns anyway without trading. Treat it more as a long-term investment.
Sure, but from the theory to the practice, there is a very long long distance. You see, it's not about one thing is to be confident in an indicator. Another thing is to have your money in the market and see the price moving every day. So that's why I always say you should start trading with low amount and realize how you feel, how you react when you see some red in your wallet. Because no matter how you think that you are confident in that indicator, but when you see a loss or the price going down, for sure something in your brain will light up and will say, man, you should sell. So in that moment, would you trust your brain or the indicator? So it's not that easy to follow that pattern. And also bear in mind that of course the rate of return that cryptocurrencies had from 2012 to 2015 first, and then from 2016 to 2018, you saw from the chart that at the first time the price increase was 40,000%. Then it was 60,000%. So that means that, of course, if you invest $100 today, likely in 10 years you won't have 2.7 million using that strategy. That's why people tend to squeeze a bit the strategy because they want to earn more.
Mm-hmm. Thank you. And a question from Andy. What do you see in the near future for Bitcoin and crypto, particularly to the price when all Bitcoins have been mined?
Well, it's not in the near future when all Bitcoin will be mined, because from the projection, it will be like 2,100 something, I guess, will the last Bitcoin will be mined. There are two things that when the supply of Bitcoin will really approach the top, I think that we will be in a totally different world. Just look back 50 years from now in the past, how the financial market were different from nowadays. Electronic trading was not there. Derivatives were not basically there. And now we have derivatives, electronic market, ETF, investment product of any range. So it's very difficult to make a projection from now to then. In the very short term, instead, I see Bitcoin in our newsletter. I was saying that I see Bitcoin ranging for a few weeks and possibly a couple of months before a significant breakout on the upside. And the very key thing to look at will be when the Bitcoin will be able to stay significantly above 20K for at least 1 week. When we will have that, we can have a very significant push on the upside. Until then, there is always a downside risk of, I think, 15 to 20% for now.
Mm-hmm. Thank you. I think we don't have any more questions anymore. And unless there's any questions coming up right now, I think we can slowly come to the end. Any last minute? No? Yes, no? Thank you, Candy. Yeah, there's a couple
Any
people.
question on specific altcoin? Usually they come.
No, but we have, this was very informative and easy to understand. Thanks, Candy. Yeah, Ruben, how can people reach you if they have more questions? Where can they find you?
They can find me on LinkedIn, on Twitter. Basically, there are many ways that anyone can reach me. So I think that the most direct way is Twitter and LinkedIn, or also on Medium. They can check my articles and they can comment, and if there is anything, I will be happy to get some feedback from that.
Thank you, Ruben. Thank you.
Thank you, everyone. I hope that this was interesting, and keep accumulating Bitcoin.
Thank you, everyone.
Thank you. Bye-bye.
Thank you.